Hello, this is the monthly update for the Argonaut Absolute Return Fund covering February 2023. Barry, what happened to the markets during the month and how did the fund perform?
Well, Rory, equity markets weren't as perky as what they had been the previous month. They were down in the US and flat in Europe. Commodities saw generally profit taking whilst government bond yields rose. We also saw companies report their 2022 full year results. These were generally okay. Remember that corporate profits are measured on a nominal basis. So the fact that inflation is high, nominal economic growth is still high, is still supportive of corporate profits. We did, however, see weaker companies blame the macro for what was probably their own wrongdoings and find it more difficult to access capital. In contrast to that, the fund had a very good month, rising nearly 7% and making money in both long and short books.
What were the best performers in the long book?
Our best performers was our shipping exposure. So remember, we have talked about this last year in what we're seeing in shipping is actually the deglobalization of trade. So a disruption of trade routes, which is leading to much longer journey times and therefore more demand for shipping at higher shipping rates. So specifically in February, the EU embargo on Russian oil products, so diesel, gasoline, etc., came in. And this led to quite a significant rebound in the price for hiring ships, and that fed right through into profits of our shipping investments there. And it'd be fair to say, you know, the reason why we think these are particularly good investments is that these shipping companies have paid off their debt, they're not ordering new ships, and therefore all of these excess profits can just be paid out to shareholders in the form of dividends. So quite a wonderful cash machine to invest in.
What drove positive returns from the short book?
Yes, so in contrast to January, where shorting was almost impossible, February whilst easy, was pretty good for shorts in that we made money from more than half of our short positions. And our best performer was actually the same as what it was in January, the US biotech company Moderna, which fell 20%. And the reason for that is that, you know, demand for COVID vaccines has diminished, and that's the only product the company has ever had. The company is burning through its excess COVID windfall profits with really very high R&D and general costs, and it's trying to convince the market and eventually governments that its mRNA platform can cure cancer. And we're pretty skeptical about that, given that we didn't see arguably any sustainable immunological response to its COVID vaccine. So I think, you know, the market and governments have been fooled once by Moderna are not going to be fooled twice, and we think this company is going to run out of cash much sooner than the market thinks.
You mentioned last month that the start of the year could look like a Goldilocks scenario for investors. Is this still the case?
So in the February FOMC conference, Chairman Powell noted that the disinflationary process has started, which is really what the market's wanting to hear. And given that this is happening at a time where the global economy is, if anything, accelerating rather than decelerating, and bears can't agree on whether the economy is too hot or too cold, you've got de facto, I think, a Goldilocks scenario. Now, I think the debate for us is how long that Goldilocks scenario is likely to last. Certainly, we think that by the summer, inflation will probably have stopped falling and start going back up again. And although inflation fell during the month, it didn't fall as much as what the market had expected. So I think there's this window for risk assets whilst we're in this, if you like, this transitory Goldilocks scenario. And you could argue that that window's already closed, given that inflation is already proving stickier than what the market had thought, and that will require higher interest rates for longer, which the risk assets won't like. So I think that this is something to be very vigilant about, that, you know, there's a debate in the market as to how much of the sticky inflation last month was a cause of the January effect, i.e. Contracts and prices being renegotiated at the start of the year, which won't reoccur over the next few months. So the debate is really out on that, but I think it's very important to remain vigilant.